Hey everyone, welcome to the Bigger Pockets Ride Along YouTube live show. So I'm Chris Lopez, the guy not wearing a hat. Terrance Doyle, my co-host and buddy,
6 feet, Chris. 6 feet. What's up?
Is
good to see you.
Wearing the hat. So we are new to YouTube live here, answer some questions. So we're going to give you a couple updates on what we're seeing in the marketplace, some of our conjecture and hypotheses on the COVID and how it's been in the rental market. So start typing in some questions here into the channel, and we will start answering those. So Terrance, we were just we were chit-chatting before we went live on here. And first off, congrats on this amazing deal under contract here in Denver.
Yeah, we worked on it for a couple of months, and I think you and I had talked about it when we initially put it under contract. It was a 40 unit in a neighborhood that we really liked, just a core Denver neighborhood with not a lot of multifamily. There's actually a brand new development going on across the street, like 200 new homes between $600,000 and $800,000, which if you're in Denver is actually not that high of a price point. And the seller had owned it for 25 years. So legacy owners had a very low basis in the property. They didn't owe anything, and they were looking to get out. One of the sellers had some health issues, and yeah, we put it under contract at $122 a door. And then we were able to do our inspection, do a rent study, and come back, and we were able to get a $600,000 price reduction, which is the largest
that absurd
I've ever seen in my history. Yeah, so we're really excited about the project. I think it's going to be a lot of work. We're going to have to redo everything, but I think it'll be a really good property for our investors and for us to execute our strategy on. What are you seeing in the market? What are your clients buying? What are you seeing in Denver?
A lot of our clients, I'd say about 80% of our clients, they're still buying. The way we've boiled it down to is that, Denver, we're still seeing appreciation.
Right.
So far, rent collection has been on track with what we've seen last year. But for people that are in a good financial position, for their job or their business, they got healthy cash reserves, they got a rainy day fund, and they have that long-term investing mindset. They will hold it for 5, 7, 10 years or longer. They're not worried about it. I just feel like, hey, we might dip. Mm-hmm. They might be the unlucky person gets a tenant that doesn't pay, but long-term, they feel like it's still a great long-term, just great long-term
place to
investment.
Put their money. Yeah.
I picked up another rental just 2 weeks ago.
Nice.
Just a straight rental. I'm a big fan right now. I was before, but now I'm even a bigger fan now of Section 8, which is like, the government subsidized housing, like get guaranteed money.
Yeah.
I think as we and I are talking, there's one segment like Class C maybe segment of tenants that unfortunately, man, they're just getting they're having a hard time in jobs and life right now. It's just the way economy is going.
Right.
And so that's the one area from a rental standpoint I would be shy of. But if you're doing, Section 8 or higher, a step up above that, there's no major fear out there, red flags that we see.
Yeah, people are still working, people are still paying rent, and there's still people, buying properties. And I think there's still a ton of opportunity out there. Like you said, I think the key is as long as you have a long horizon and you're not looking to make a quick buck, and you have you're able to weather the storm, there's going to be ups and downs. There's going to be a little bit of a roller coaster, but I think long term, there's a lot of opportunity.
Ooh, we were actually just we got some questions rolling in here, so we're going to start going through those. This one from Jim jumped out to me. So Jim says, with people flocking to the suburbs for single-family homes, do you ever feel that multifamily, 4 units or greater, are at risk right now, or am I wrong? And are people still looking at apartments?
Yeah, we were just talking about this. Yeah. That's an excellent question, Jim. There's a lot of people that own multifamily, especially large multifamily right now, that feel that way. The seller that we're working with here in Denver on that 40 unit, I think might have that kind of feeling that this is the beginning of the end of multifamily. I was kind of relating it, you and I were talking about what I'm seeing. There's a couple larger buildings that we're working on in the Midwest with sellers that I think have the same fear, that they think that people are going to go to the suburbs. They want to live in single family homes. They want more space because of the pandemic. This is going to start this trend where people don't want to live in confined areas close to other families. And so there's some fear and there's some unknown. I think with the eviction moratorium, there's, that kind of plays into it. But I think it's kind of similar to, Apple, Steve, when Steve Jobs passed away, people were like, oh man, it's the end of Apple. Tim Cook doesn't know what he's doing, and people are selling Apple. And obviously Apple's continue to do well. We just believe if you buy core neighborhoods and you're conservative on the underwriting with rent bumps, I would think the one thing that I would agree with Jim is that you can't underwrite 5 to 8% rent increases like we have in Denver, like we've seen in Denver the last 6 to 7 years. I think you have to be very conservative on what the rents are. You have to really understand what the maintenance is going to look like in your tenant profile. But people still need a place to live. They need an affordable place to live. And there is a housing shortage in most cities in our country. You know, Denver has one of the largest, I think, discrepancies in supply and demand for places for people to live, affordable places for people to live. And so I'm still bullish on multifamily. I think where we've tightened up our underwriting is in the rents and in location and the tenant profile. We're very particular on, the class of building, who the tenant's going to be, and what their income is in that area. But I think as long as you are taking all those things into account and not being ultra aggressive on rent, especially in the next 12 to 24 months, I think there's still a lot of opportunity in multifamily. But there is that sentiment out there that it's the beginning of the end.
So I agree with you. I got a few more things to add on there because, since the pandemic started, we're here in Denver. I think we mentioned that, but we're here in Denver. And so I've been interviewing property managers every month. Kind of get their stats and their feeling, because they got to finger the pulse of the rental market. And the only segment of the market where we've seen like rental prices drop and vacancy and rental demand drop significantly is the downtown Class A stuff.
Right.
If you guys been in Denver, like a lot of downtowns, we got a lot of like brand new Class A. It's been booming.
Right.
And the apartments have not been overbuilt due to like supply and demand. But why do people want to live in downtown Denver? They're going to be a young professional. They got money to spend. They want to go to the Rockies baseball games. They want to go to bars and nightclubs and restaurants. I mean, I did when I was 25 years old.
All those things that are closed now.
But they're closed. There's rioting. There's, there's not that huge allure there. So I've seen stuff impact has been that like the big buildings downtown. Maybe people are afraid of elevators.
Right.
But here's the thing. Like, some of those people are flocking. But here's the reality. There is not enough inventory for people to move out of apartment buildings.
Right.
And for a lot of the stuff that you and I are buying, we're not buying that Class A stuff. We're buying Class B stuff, Class C plus stuff, more out in the suburbs. These are working class tenants. A lot of them don't have the options. Oh, I can work remotely. I'm going to go move to my dream ski mountain town in Doyle or Breckenridge.
Yeah, that's a good point.
There's no inventory. And a lot of those tenants, the fact is they don't have that position to go out there. Oh, cool, I'll move to the suburbs. They need an affordable place, and that's going to be like an apartment building. But for the demand we see, we do a lot of stuff like that, 4 to 20 unit range. We've not seen a huge drop off in demand. We've still seen a lot of people renting them out, and actually some of our PMs are still increasing rents.
That's interesting. Yeah, we've been collecting rent. People are paying, and we haven't seen just a mass exodus of apartments.
Here's a good one.
Vince
says, what is your best advice for managing from long distance? I'm currently managing a duplex from 1,000 miles away through a Google Voice number, an online tenant platform, and an on-call handyman. Well, that's creative, Vince.
Nice work.
So I wanted to pick this out because Terrance has lots of experience. I think your black eyes are gone from doing some of that. No, but I mean, in reality, like, we've had many candid conversations. Like you've gotten beat up in the past and lost some money, but now you're doing a phenomenal job. You're living in Denver. You have 300 units in Des Moines, Iowa.
350, yeah.
What was that? I don't know, that 1,000? I don't know how far
it's probably 1,200. It's really close to 1,000 miles away, Vince. So pretty similar. Yeah.
So what would you do?
So Vince, I think if you're looking to grow your portfolio in that market that's 1,000 miles away, if you think that you have a competitive advantage, one of my big things, we've done podcasts, I've done blogs and spoken a lot on this, because a lot of people, if they live in a dense suburb with rapidly appreciating prices, they have this idea that I can go out of state and get better deals. So if you have a competitive advantage, so if you have access to off-market opportunity, if you have family there, if you have anything that separates you from the average investor on the ground and you're looking to grow that portfolio, I think, one of the big things you're going to want is someone on the ground as you grow, either a property manager, a maintenance man, like it sounds like you have a leasing agent, even a lender, a local bank, someone at a local bank that, can help you to grow your business there. I think local banks are really underrated with how much they can help if you are out of state. They know construction companies They know the best property managers.
Oh,
I mean, they're going to know the best insurance agents, so having a local lender that can be your eyes and ears there. Now, they're not going to go and collect rent for you, but they can tell you who the best person is to collect rent and to lease up properties, handle the maintenance, besides giving you the best debt for new properties. I just think you got to have someone there that you align interest with. What I did was, my dad lives in Des Moines, my brother lives in Des Moines, my sister now lives in Des Moines. So I've been able to have, family and really close friends help me to grow my portfolio. But initially when I started, I was flying back to Des Moines from Denver every week or every other week to manage construction, to make sure we were collecting rent and to oversee that. And then obviously as I grew my family, that wasn't sustainable. And so I had to have, my dad and my brother get more involved. But I just think if it's going to be a one-off thing, I like what you're doing. You've kind of hacked it together. You seem very, very crafty with how you've put that system in place. As you're looking to grow, I think you need to have a partner or someone that your interests are aligned with on the ground. Maybe you tie some profit sharing with someone there that's going to collect rents and manage and put out fires, or, some creative, arrangement with someone there that you can, that the better the portfolio does, the more money they make. And then you're going to see a lot better results. As Chris said, I've had a lot of pain, when I first started doing that, and, from tenants not paying, overpaying for maintenance and repairs, to contractors stealing money. I mean, you name it. And it happened to me those first couple of years. Everything changed, and we started to turn the ship around once I had someone on the ground that was on my team and our interests were aligned.
What do you think about, Vince, he's doing this with a local property manager. How do you...
Yeah, I think you can do that. When you have under 10 units, maybe even under 20 units, you can do that. I just think as you looked at, that's why my first question was, Vince, if you're looking to scale and you have a competitive advantage in that market, I think you need to look to start to build relationships with someone that you can, think about the future. If once you get over 20 units, you're going to want someone on the ground, because it's not about if bad things are going to happen, it's when.
Yes.
They're going to happen. You're going to have a flood. You're going to have a fire. You're going to have some kind of crime. You're going to have an eviction. You're going to have some things that you need someone there in the middle of the night or on a weekend that can go and help you out. And so I would just start to think about and start brainstorming who's going to be that person for me on the ground that can help me, and we can align interest.
And so I don't have any near the experience you have, Terrance, but the very first property I bought, probably maybe a decade or so ago, I moved into, I lived in it after I moved out. I moved to a different
state. You did really well in this condo, I think.
Yeah.
I remember. Yeah. Well.
But I turned to a rental, right. And I was like, self-manage. But what I did, and this worked out well for me, then kind of my life changed, is I actually hired a property manager, and they did tenant screening and tenant placement. So I think I paid them $500 or half a month's worth of rent.
Right.
And what they did is they did all the showings, they did all the tenant screening, and then they were also the boots on the ground. And then once the tenant was placed, then I just took over the management. So I like that aspect of it. It was nice. A good balance there. And the other thing is I talk to my tenants like, hey, look, if it's something like in the middle of the night, if it's something like, hey, it's urgent, hey, call the service provider, right. Call the heater. I'm like, hey, if I have to eat, a $200 AC service call once a year, I'll eat that.
Right.
For me, that was a good trade-off. Then I started getting busier with work, and I think I had starting the family. I was like, I can't do this long distance management. Right. It's just too much headache. But I would definitely look at a PM who might do tenant placement for it if you need help as well.
It's a good idea, yeah. And you had one condo,
Yeah.
I think if you were looking to buy 10 of those or one a year,
very different what you
would
had.
Have probably been,
Yeah.
It probably would have been a little bit more strategic, or you would have looked at. I think, Vince, between 20 and 50 units, you can have just one person on the ground that's going to just make your life so much easier. You're going to sleep better at night. You're going to have someone taking care of those issues in real time. So I love what you put together there. And I think if you're looking to scale, I would definitely look to bring someone on to help you with some of those things on the ground.
All right. Logan's got a couple questions here. So let's go to Logan. Logan, and I'll read both questions here. Logan says, when you look at running the numbers on a multifamily, do you run less capital expenditures or capex? The reason I ask is the whole property, or is it lower since the whole property is under the same roof? Also, when analyzing higher income rentals or even lower income rentals, at what point do you start running the number at a dollar amount versus a percentage? Water heaters at $750 versus $500 versus $3,000.
Yeah.
So a couple questions there, so great ones. But let's start with the capex one first. How do you run capex when you're looking at that?
Yeah, you could. It depends on the year that it was built and the climate. Honestly, we are more conservative on capex in the Midwest because of more moisture. It has 4 different seasons, so the property just gets much more wear and tear. The furnaces get beat up in the winter, the ACs get overworked in the summer, the roofs get beat up with hail and crazy windstorms. And I think there was just a cyclone in Des Moines, a couple months ago. So you name it, and the Midwest sees it. Generally speaking, Logan, I'm trying to inflate numbers on my pro forma so that I can beat them. The actual numbers will be better than what I put on paper.
So you're being conservative, like
you want to be, especially if you're just getting started, you want to err on the side of caution. And so for me, we put in $250 per unit per year, just because even though the roof that is under one roof, normally a boiler system is super expensive to replace. If you have a 4-unit, 8-unit, obviously the larger the property, the more expensive that boiler is to replace. So even though the roof may be one of the few things that you'll save money on from a single family to a multifamily on a per unit basis, virtually everything else gets more expensive. There's more windows, there's more units, so the boiler's more expensive. There's a foundation issue. All of those things end up becoming more expensive. So I think you almost want to increase capex the more units you have versus decrease it. Things just get more expensive the larger the building is, and the service providers that work on a duplex or a single family home are much more expensive when you get into 10, 20, and 30 unit properties. So the punchline is the larger the property, the more capex I would underwrite to be conservative.
And going back to kind of the second part of your question here, Logan, at what point do you start running numbers at dollar amounts versus a percentage? So, I mean, the way I look at this, I don't run anything at dollar amounts except for like initial repair costs, because you can usually estimate, during your initial walkthrough or during your inspection due diligence phase, hey, we got to replace this.
You can drill down on a number.
Hey, it's going to cost 5, 10, 20 grand. But I use a percentage for pretty much everything for like repairs and maintenance and capex long term, because I'm a very much like keep it simple, stupid guy.
Mm-hmm.
And something else I've noticed too is like when I've been around more experienced investors, been around for 10, 20, 30 years, it almost seems like the more experience they get, the simpler way they get long term. Like, hey, it's going to average out to be about 11% for my entire portfolio.
Mm-hmm.
And I've talked to property managers about this. So I think I like using percentages, but make sure you know what works in your market. Like I know bigger pockets, a common theme on the bigger pockets forum is that 50% rule, that, hey, 50% of your rental income will be used to cover your operating expenses.
Right.
Well, that works in some markets.
What I've found is property tax, normally in the Midwest, property taxes are much higher. So you are 50%. But when you're in Denver and other markets that have really low property taxes, I think some of the Southeast has really low property taxes, you're closer to 25 to 35. Yeah. Property taxes really drive those expense ratios higher, because Denver we're closer to 30. Yeah. Just because property taxes are lower. I mean, maintenance is roughly about the same. Insurance is roughly about the same. But the big one that moves the needle is property taxes, in my experience.
That, and I think repairs and maintenance, because, if you're collecting, what's your average rent in Des Moines?
$750.
What's your average rent in Denver?
$1,250.
Okay, so $500 spread, right? What's the cost to replace water heater in Des Moines? What's the cost to replace water heater in Denver?
About the same.
Yeah, it's about the same.
But the percentage is
and that's less, why, and that's why I say, cool, water, let's just say $1,000 for easy math, get it permitted, installed, all that. Well, that's gonna be a much higher percentage of like a Des Moines rent versus your Denver rents. So you got to understand, hey, if you're in a higher end area like Denver is, or Austin or Salt Lake or one of the coastal markets, you're gonna figure out the percent, but it's gonna have to probably be a lower percent than compared to a cash flow market like Des Moines or a Midwest market.
That's right.
Yeah. All right. So Logan, hopefully it helps you. But basically, like, I think we're both fans of using dollar amounts for initial rehab and then percentages for ongoing, right?
Yeah, we've done both. I mean, Logan, I think the key is just to be conservative. You can definitely use a dollar amount. I think once we rehab a unit, we like to use $60 a month in repairs and maintenance per unit. So per unit per month. And you can drill that into a percentage or a dollar amount. But we're just trying to be conservative, so that way we know that when we're actually in the game and we're owning the property, we can beat those numbers we put down on our pro forma. But I think it's You can interchange the percentage and the numbers. The key is to be conservative.
Yeah, and they no matter what you do, because you always do the dollar amounts. I always do percentages, but things when we do it, we're usually within like a couple
You end
dollars
up
of
right
each
at the
other.
same. Yeah, you're gonna end up at the same place.
Like
there.
you do your repairs and maintenance and capex, you're at like 6 or 7%. I'm at 8%. Like
Right.
we're not that far off.
That's right.
So get something, but you have to be consistent either way. All right. There was another question on here.
Andy's
Okay.
got an interesting one. All right, let's start with Rick.
Rick says, given the current economic conditions, when can I expect to find a bargain if I'm looking to buy multifamily, 20 plus units, and how much of a bargain can I expect to find? I mean, now you can.
Yeah, it's kind of like, when should I invest in the stock market? It just keeps going up. You know, you kind of have to dollar cost average in. You know, I think that's a really disciplined, measured approach to investing in any asset class. As it pertains to real estate, you know, I've heard the same thing since 2014. Really, is, you know, how can you find deals? Everything's so overpriced. There's all these out-of-state investors. There's no deals. And then when I switched to multifamily, it was kind of the same thing. And I think the key is just to build really strong relationships. There's no shortcuts, Rick, to finding a great deal. It's just over time, you build relationships with the right people, and that you have to be intentional. Who are the brokers that are operating in the 20 to 50 unit space? Who are the brokers that you have the most in common with that do that? And be intentional about reaching out to them, building a relationship with them, find a way to find some commonality with those brokers. Be consistent about your follow-up with them and your communication. So, you know, put reminders on your calendar every 2 weeks, follow up with Joe, who's the top, you know, broker that, you know, trades these kind of buildings. And over time, he will bring you the right deal. You know, obviously, I think, you know, one of the, you know, just the fundamentals of finding deals, you have to be pre-approved. So if you're meeting with the top brokers, you're intentional and you follow and you're consistent about your follow-up, and then you show them that you're pre-approved, or you have a proof of funds, you know your buy box. I think you have to, if you're going to meet with brokers, especially the top ones that are sophisticated, that are dealing with a lot of sophisticated investors, you have to be specific about what you're looking for. You can't just show up to a meeting with one of the top brokers and say, yeah, I'm just looking for a deal. I want 20 units and I want a deal. That's, you know, or a discount or anything even close to that kind of story. You have to say, hey, I'm looking for this kind of cash on cash. I'm looking for this, you know, year build with this much value add or this much construction needed, you know, this location. The more specific you can get with what you're looking for, the better chance you're going to have and the more motivated the brokers are going to be to go bring it. So if you show up with a pre-approval letter, a proof of funds, and a really specific buy box, and you're following up with them on communication, you're going to get a deal and you're going to find a bargain, as you're calling it. You just have to be patient with those relationships. But the more intentional you are, the more consistent with communication, you know, the better chance you're going to get and the faster it'll happen. Because at the end of the day, these guys are 100% commission. So they're going to spend time for the clients that they really believe can execute and close, so that way they can get paid. So if you put yourself in their position and you're 100% commission and you got 5 people calling you saying they want a deal, but you got one guy that showed you that he has cash in the bank, he's got a pre-approval letter and really specific about what he's looking for, you're going to spend more time looking for properties for that guy. Yeah. And that's what I think that would be my piece of advice to you, is be that guy that they're really motivated to go and find the deal for.
And I would say have the mindset that there's always deals out there.
There's always deals. Yeah.
And the other thing is, don't wait for the perfect deal and then spend 5 years sitting on the sidelines. I meet so many investors like, oh, I gotta find something at this cap rate or this deal.
Right.
And then that was great in 2016, in 2017, in 2018, 2019, 2020. They never done anything.
They're still on the sidelines. Yeah. Action. Take action. Yeah. And I think that action is reaching out, being intentional about doing some research. Who are the brokers? Finding guys that you have commonality with that are in that space, reaching out to them. And then when you reach out and you get that meeting, it may take a little while to get the meeting, but once you get that meeting, you got to show up prepared to have your shit together. And if you do that, I think you'll do really well. Yeah. And you'll see some results.
But I mean, you already got a couple, I think you've gotten 2 deals so far of just, you know, legacy, you know, long-term owners. And they're like, hey, market's going crazy. They either want to, you know, take their money off the table, or they think the world's going to fall apart. So they're selling. Yeah.
From 2016 to 20, you know, pre-COVID, I mean, everybody in real estate, and regardless of asset class, hospitality, you know, office, industrial, was like double-digit returns. So everything was hot, you know, in Denver. So everybody, it was hard to find a deal. And there's always life events going on. People are getting divorced. There's health issues. People have different crazy circumstances with, some deal goes bad and, they need cash. So there's always opportunity out there. Rick, I would just challenge you to build relationships and be consistent and be very clear about what you're looking for.
All right. There was another question you wanted to do. Was it
Milton or Andy? Andy right there had one on multifamily,
yep.
I think.
So Andy says, what are your thoughts on multifamily properties built around 1900? What are some considerations needed to be considered beyond the usual due diligence?
Yeah, that's an interesting question. So in Des Moines, I've actually purchased properties built either 1890 to 1910, so very old. So one of the things is on lending. Lenders are going to be much more conservative on the underwriting. So they're going to inflate your capex and your repairs and maintenance, especially if the property hasn't been turned recently. And they're also going to be conservative on the LTV. They're going to lend less just because the year that it was built, and they're not going to want to probably give you a loan for more than 25-year AM. Most of the ones that I did were on a 20-year AM schedule. Because the longer term of a loan that they give, the more risk that they have and the more exposure. So one of the things I would underwrite is you're going to probably have to pay more in principal and interest every year because they're going to give you a shorter loan term. The second thing is just repairs and maintenance are probably going to be double. So if you normally are at 50 to 60 a month in your market per month per unit, you're probably going to be closer to 90 to 100, just because the pipe, the plumbing's old, the electrical's old, the floor joists, the roof, so I would pad my capex, because if it's an original boiler, original roof, original foundation, you're going to spend a lot of money in those areas. And then the repairs and maintenance are going to be more than what you're probably used to. Now, the flip side of that is you can get some great deals. I bought some killer deals from legacy owners, properties that were really old. They just didn't want to deal with the maintenance. They didn't want to deal with the capex. And we were able to come in there at a really low basis to create some good value for our company. So I think you got to be extra conservative on the underwriting with capex and maintenance. You got to underwrite a little bit shorter term on a loan, most likely, depending on your financials. But the flip side of that is you can get some really great deals with some older properties, just because people are tired of dealing with those issues.
So we got a follow-up question here from Logan, who earlier asked about the capex. He says, I invest in lower income areas, so that's why I ask. So 5% of 500 is only $25 a month a unit in repairs. I just want to be sure I'm conservative enough. So this is where you have to kind of like figure out where your market is, and also based on your rent. So I mean, generally, the lower the rent, the higher percentage
that's right,
of your repairs and reserves are going to be. So, I mean, in Des Moines, in Denver, you're in about $50 a month for repairs and reserves.
After renovation, after we renovate,
okay,
and we're holding long term, when we refinance, we're depending on the year of the build and the location, we're between 50 and 60 after renovation.
Now, but do you run? Okay, so let's say you buy 100 unit here in Denver, 100 unit in Des Moines.
Des Moines a little
pretty
bit higher.
Similar specs.
Yeah.
And similar asset, all asset classes, but Denver brings in $1,000 a month. Des Moines brings in $500 a month. Do you underwrite both properties at $50 a unit per year?
Des Moines a little bit higher just because of the climate, the humidity.
Okay. So you actually
controls
repairs higher.
There,
what would you run it at?
So in Denver we're at 50, and in Des Moines we'd probably be at 65.
Okay, so this is interesting. So let's do this math. I'll do math live. So $50, over 1,000 is 5%, right? Yeah, that's 5%. You said $75?
We do 65 in Des Moines,
okay,
just because of the climate. Yeah.
So 65 divided by 500, or no, you used to drive around like 750, right? We'll do 500. Keep it simple.
That's fine. Yeah.
Is at 13%. So if you have the same asset classes, similar types of B-class neighborhoods, similar renovations, you can see right there in Denver, we're running a 5% repairs maintenance capex. In Des Moines, that's closer to 13%.
Right.
So you're going to look, as Terrance has been saying, look at like, hey, what's the cost out there? And 5% in repairs and maintenance on a $500 a month rent seems really low to me.
Way too low.
Yeah,
I mean, too low. Even for new construction, it's going to be more than that. I think that if it's not renovated, you need to be closer to $80 per unit per month, unrenovated, depending on the market. Now, if there's a lot of humidity and it gets really cold in the winter and there's tornado, or other kind of climate factors, you could even be north of that. I just think, if it's unrenovated and you don't have full-time maintenance and you're going to have to call a handyman or a plumber to go and fix things, I think you probably need to be unrenovated closer to 90 to 100. That would be my thing for a new, and if you're just starting out, Logan.
All right. And Logan says, and that just capex or capex or just repairs?
Capex should be 250, so separate. Capex is for roof, boiler, foundation, windows, just, once every 10-year kind of items. 250 per unit per year. 250 per unit per year capex. Maintenance, repairs and maintenance.
Pause.
Yeah.
Is that 250 both in Des Moines and
So we
Denver?
do the same thing in Denver.
Okay.
Yeah, for that, because it's more long-term, and
so for
the
capex,
properties are
the
properties are much larger in Des Moines, so we have 50, 100, 200 unit properties there. So 250 per unit per year ends up being a big number.
Okay.
Even though the items may cost more. And then on maintenance, unrenovated, I think a good blend is probably $75 to $80 per month per unit. That's kind of what what I would do.
All right. Hopefully that answers your question, Logan. Hey guys, we got a lot of thank yous in here. We appreciate that. A big favor you can do for us is, we got a bunch of these ride-along shows that we publish from Bigger Pockets. A new one comes out in 30 minutes. When those videos come out, please like those, comment on them, leave us some love, because that, we like it, but in reality, that tells Bigger Pockets show does well.
Right.
And then we can do more of those shows. And we actually really love just kind of BSing about real estate all day.
Yeah.
So please leave comments on the actual ride-along shows, because that's a good loop for Bigger Pockets to throw us more airtime as well.
Yeah, we're going to try and be doing these every Wednesday. So talk with your friends that are in real estate, share it, post it, so that we can get more engagement and get, the more questions we have, the better conversation we can have, and it'll be more valuable for the audience.
So we're going to get through lots of good questions coming in. So follow up from Andy, who is asking about the older 1900-ish builds. Any additional or hidden considerations for recently renovated older duplex? What I can think of is I've heard these stories. You got to go through and just look at the size of the doors and the door jambs. Because a lot of times back then, they didn't have the standard doors where you go to Home Depot, or the standard, ADA accessible stuff. Hey, it might be an 8-foot door with some weird width. And if you have to replace that door, you have to get a custom door made, or, look at the sizes of things, or the way, that type of stuff. That's very cool. Replace the door. If that door's not a standard size, well, now I've never had a custom door built, but I imagine that's way more expensive than Home Depot and getting one ordered.
Yeah, I just think, Andy, if you're buying something that's renovated 1900, I would just be really conservative on the purchase price and what, the strategy is. If it's a long-term hold, I would be really careful and make sure that you're getting a disproportionate return, because there are things that are going to go wrong just because the year it was built. No matter how well something was built, when it's 120 years old and you're planning to hold it for another 10, the chances you have of something else going wrong are higher, even if it was recently renovated, just because the bones of a structure can only be good for so long. So I just think if you're buying something that's the value's already been added and you're paying close to market, make sure that you're getting a really good cash on cash return, or you're getting some disproportionate higher than normal return, because you're going to have much less risk going and buying something that was built in 1960s if it's already been renovated.
All right, so I see some more questions here and just using assumptions and underwriting. So let's keep going down this rabbit hole, because it's a good one. This is devil's in the details. Adam asked, how do you decide on your variable expense assumptions such as vacancy, repairs, capex, legal, and what percent of rental income do you generally use?
That's a great question.
It's a great question.
Ding, ding, ding. That is a great question. That's a great question.
It is so highly market dependent, property condition dependent, tenant class dependent. You can't and this is why I beat up a lot of times at the Bigger Pockets 50% rule. It's a blanket rule across the nation, across the board, across all market cycles. Those don't work. I can tell you what I use here in Denver, but that might not work for you I don't know where you are, Adam. In Denver, I use, if it's a detached property or multifamily, I use 8 to 10% depending on age and condition, unless it's something crazier for repairs, maintenance, capex. Keep it simple, stupid. That's based off of my own operating data, talking to other investors and talking to property managers. A lot of people say, yeah, on average, after a decade, I'm about 1 month's worth of rent per year to take care of everything. That's 8.125%. 8% is a good number.
It's good math.
Adam,
I think one of the punchline really is, and Chris has invested in multiple states, and I've done deals in, I think, 10 or 11 states. You need to answer this question accurately, you need to have a property manager help you with this, for the simple fact that vacancy in Denver is much different than, let's say, vacancy in New York City right now. People are leaving New York City, so vacancy, I think, is probably 20+%. People are moving to Denver, so vacancy is, I think, 3 or 4% in Denver. But people may be moving to Bozeman, Montana right now, so vacancy could be different there than it is Denver. Every market's going to be different because it has different economic factors going on based on job growth, migration, supply and demand, right? If Denver had less building going on and a bunch of migration, so people are moving here, then obviously vacancy is going to be much less, evictions are going to be much less, and rental income is going to be high just based on supply and demand. But if there's a city in the Midwest, let's say Des Moines, an area that we invest in, there's not as much migration, there's not as much job growth, it is much more stable in terms of income. So there's actually higher vacancy there. Vacancy in Des Moines is about 8% historically, whereas in Denver, the last 5 or 6 years, I think it's been 3 or 4%, simply due to job growth, migration, and supply and demand. There's much more demand here for properties and much less supply. And so there's so many factors you really need to talk to. I would recommend 2 things. Find a really good local lender. So not a Chase, not a Wells Fargo or US Bank. Find a local bank in your market. Find a state or local bank that you can go in and talk to a lender, and they'll be able to tell you some factors, and they may be able to refer you to the best property manager for the size of unit that you're looking for, because lenders see everything. They see all the deals. They see who the top brokers are. They say who the top property managers are. They see every pro forma, right? Because before they're going to lend, they're going to scrub the pro forma. So I would just, talk to a property manager and a lender in your market, and they'll be able to give you the specifics. But every market is so different just because the economic factors, and economic factors are changing almost every year. So you got to stay up to date on that.
And now it's like every week, or
there's a lot changing. Yeah. That's a really phenomenal question, though.
Yeah.
I saw someone about software. Should we go to Jaron Whitlock? Up one? Yeah, right there. This is a good one.
All right. So Jaron Senior says, what software do you use to manage your business? I have an easy answer for that one, but you go first.
Go ahead.
I use a property manager, and they use
and what is your
Folio.
Yeah, that's right. Yeah. So we use AppFolio. So our property manager uses AppFolio, and then for the properties that we manage in Des Moines, we use AppFolio as well. There's 20 different softwares you can choose from. Jaron, it really depends on how hands-on you want to be, how big you're going to scale your business, and what's most important to you. We went with AppFolio. It's a little bit more expensive than, let's say, Yardi or Buildium and some other ones, but they have the best software team. It's basically a technology company that got into property management, but they're constantly improving the software. They do a lot with marketing, so you can market right from AppFolio. You can handle all of your maintenance requests from there. It handles all the leasing. So it's basically a one-stop shop, and they're constantly updating and improving the technology. So we went with AppFolio, but I think that there's 3 or 4 really good options in the market. It really comes down to your business and what you're looking to do. But if you have over 10 units and you want a one-stop shop and you're not price sensitive on $5 to $10 per unit per month, then I'd take a strong look at AppFolio.
I mean, every property manager I've ever talked to, work with, they all use AppFolio. Yeah. They just seem to dominate the market.
They're definitely the grill in the room. There's other ones that are coming up. I think Buildium's done a good job. Yardi's doing a lot. I mean, there's other ones that specialize in different things. For instance, like if you want to do your own leasing, and you just want something to help you with the maintenance, Yardi's done has a pretty good platform for that. But if you're looking for a one-stop shop that does everything and you're really focused on growth, then I would take a strong look at AppFolio.
Emery asked, what should I do to learn more about the real estate? What should you learn about real estate? And is there any website or anything that explains all the terms you guys are saying? Bigger Pockets, man.
Yeah, go to biggerpockets.com. We actually have a discount code that we can post in the show notes. But if you go there, you can actually get a pro membership or buy any of the books at a discount. And I highly recommend it. Chris and I actually met 3 years ago on Bigger Pockets. I've met a ton of really good brokers, really good lenders, good insurance agents. I mean, basically anything you need, Emery, any resource you're going to be able to find on Bigger Pockets. They have really great calculators for underwriting properties, and they just do a really, really good job. And it's the number one place to network and to educate yourself.
So in the comments, we just put the coupon code for the BP annual or what I'm trying to say, pro membership there, which we both have. These questions are right up your alley, Terrance. Another great question from Logan. He says, hey, when renovating properties, what specifically do you try to offer in your units that set you aside from others in the market? What makes you stand out? And I'll say, before you answer that, listen to what Terrance says, but then go back and watch the previous ride-along shows we've done, especially some like the multifamily properties, because you'll hear what Terrance says, but in those properties you can actually see what he's doing, from bases like in-unit washer and dryer to, I think, that first one we did in that 6-unit on Wolf you did some pretty cool tile and some other things to jazz it up. So listen to what he says, but also watch what he does in the videos as well.
Yeah, you can. Yeah. So overarching from what we do on a micro level is you have to know the area of town you're in. So in a lower income area, I may not do granite, or I may not do tile in the bathroom. In a higher end, I'm going to do maybe a custom tile in the kitchen backsplash, or I'm going to do some custom shelving in the kitchen, and I'm definitely going to do granite. So, but I may just spray, I may do a resurface the countertop if it's just laminate and it's a low income area. But I think, some of the things we've done is add washers and dryers. We most likely always do tile, a 12 by 24 ceramic, which is just a more modern size of tile for the bathroom floor and the bathroom shower wall. I mostly always change out the plumbing fixtures in the showers to give it more of an industrial modern look. We always change out the toilets for obvious reasons, but some people don't, and their toilets are $100, but it just shows a property much better. We always take out carpet. I think you're going to get a great return, and it's going to show a lot better if you do an LVT or an LVP, luxury vinyl plank. And basically it's just better for wear and tear, and you don't have to change it out every time a tenant has a pet and you're turning the unit. So those are some of the general things we do, but you can see videos that we've done on Bigger Pockets on YouTube and on any social media platform on some of the renovations I've done. But it really comes down to the neighborhood and the tenant class. You always have to think, who's the tenant going to be, and they have to build backwards from there.
Hey, also, what's your IG handle?
At Terrance Doyle. You can see a lot of the renovations we've done on my Instagram or LinkedIn. Yeah, Doyle. Doyle.
Doyle.
Yeah.
So I'm gonna put it on here, just on the banner. So go to @Terrance Doyle. Forget that period at the end. I somehow screwed that up. We will fix that.
You're doing so good up to that point.
I know. @Terrance Doyle on IG.
Should we do one final question?
Yeah, but I'm saying that's a great one to see some renovations. Watch the Bigger Pockets ride-along shows.
The ride-along shows, we go into detail on neighborhoods, on finishes, on what gets us the best return. Washers and dryers in certain areas will get us an extra $75 to $100. Kitchen subway tile backsplash will get us a return. Granite countertops. It's very specific to the neighborhood.
How about this Midwest market?
Let's do it.
Because you invest in Denver and Midwest.
That's
so
right.
Andy says, what are your thoughts on the Midwest real estate market in general, looking at a 5 to 10 year time horizon?
Yeah, this is actually something I am pretty well versed on. I'm from Des Moines, Iowa. I spent a lot of time in Kansas City, Minneapolis, and Omaha growing up. So I know the Midwest pretty well. So what's interesting is some data for you. So since April, we've collected 96% of rents in Des Moines, Iowa, 96. Denver, we've collected 90, just a little under 91. So what that tells me is that people in the Midwest, and this is my opinion, but those are the real facts. My takeaway from that data, Andy, is that rents are much less. It's a lower cost of living, so people can afford it. So when times get tough, normally they're able to pay rent much easier than in Denver, where rent is $500 more a month, $6,000 more a year, right? So because it is more affordable, you see a higher percentage of people paying rent. The other thing we've seen is much less occupancy, much less delinquency, right? So people
in Des Moines
than Denver. Yeah. And I think what we've seen is that people have much more blue collar jobs and are doing much more manual labor there, and just higher employment in a downturn. So I would say that, Denver's unemployment maybe 20%, and I would say Des Moines maybe half that right now. You just see a lot more people working there versus larger cities that they're much more reliant on some of those jobs, at a gym, salons, some of those they're just much more sensitive in a larger, like New York City. I think 30% of the employment force is like hospitality, either a hotel or a restaurant, bar. It's something like that. I was actually reading on Bigger Pockets. But so I just think in smaller Midwest markets, less people are dependent on hospitality, hotels, and bars, just because there aren't as many per capita as there are in larger cities like Denver and New York.
That's an interesting observation. Never thought about it that way.
So we've just seen, my punchline to the Midwest and why I like it as a hedge to Denver or other high density markets is it's much more stable. Des Moines is going to just chug along at one or maybe no rent increases, but people are going to be paying, right? And same thing with single family market in Des Moines, virtually no appreciation. Actually, my brother and I were talking about today, homes that we bought 4 or 5 years ago maybe have appreciated $3,000 to $5,000. And in Denver, you're seeing 8% year over year, right? So homes that you paid $400,000 for 4 years ago are now going for $600,000, right? So that's very typical in a market like Denver. So very volatile. So up and down, much bigger swings. Des Moines in the Midwest, very steady. So I like the Midwest as a hedge. Or if you're just looking for cash flow but not a lot of appreciation, I think the Midwest has done really well and will continue to do very well.
All right, guys. Well, we got to wrap up here because, we're in Denver. I've got a 3:00 appointment with a client, so we got to wrap up a few minutes early, and then you got to get running to Terrance to go check out a property. So, guys, we appreciate you listening and watching. We're actually got a brand new Ride Along show coming out today. I'm going to put the link in the comments right now. So it's going to drop live in 12 minutes or at 3 p.m. Mountain or whatever time zone that is where you're at.
Yeah, go check it out. We'd love to get your feedback and hear what you'd like to see in future episodes.
Yeah.
We're really excited about this one. It's a project we worked on for a long time, and we put a lot of time into the show that we did, and we're really excited to see what you guys think.
And also, if you guys have watched the other shows, we recorded those first 6 shows. We got some great feedback from you guys, from Bigger Pockets, from watching ourselves, and we changed up the format slightly. So we'd love to hear your feedback on there. Drop the comments in the YouTube or find us on Bigger Pockets as well. If you're definitely want to get in touch with us, find us on Bigger Pockets and message us. We're on there. I'm on there at least a few times a week. I think you are as well. So guys, check it out and please like it, subscribe. It helps us out. Tells Bigger Pockets the show's doing well, and we keep doing more and more and more of those. So this drops, and then 2 weeks from now, we get the next show dropping as well with another YouTube Live. So Terrance, thank you.
Nice work, man. That was
awesome
great.
Show.
Thank you guys for participating. Great questions. Let's do it again next Wednesday.
Bye, everyone.